All right. Hello, everyone. Thank you, Marty, for inviting us again to speak. And it's great to see some familiar faces. And we've been before talked on Nexxess Business Advisors, more on trust structure. But what we want to do today is kind of hone in and talk about specific division that we feel can be a great value add to our family offices and the advisors that surround them. Speaking on more of corporate sales and advisory and what we do in that area. And I have here, let me turn this on here. See my hand, clickers not working. Excuse me. There we go. Okay, so it's a little bit about me. 20 years in the financial space, started in residential lending and expanded into financial strategies in 2008. And from there, it's been a financial literacy mission, looking at different strategies that can really be a value add, looking at any of those types of investments that would be good, but then migrated in the past 3 years, expanded into trust structure. There's only so much money that we can work with, that you get to keep, but we're not talking about deferring of the tax and deferring of capital gains tax when maybe you want to sell a business or, look at an opportunity to acquire. And looking at what that looks like. So I've invited my colleague, Jeffrey Brewster, and Jeffrey comes from his side of things for 15 plus years on the valuation side and really supporting those in over 1,000 valuations and, where we can come in and really service you. But you could see it's a long history of what he's been able to do, in the community. And I'll have Jeffrey maybe talk on that, a little bit, but I'm going to turn it over to Jeffrey. This slide.
Where is Jeffrey today?
Jeffrey is in Texas.
Got it.
Frisco.
You look
you're in Dallas today. Awesome. Yes. So Jeffrey, go ahead.
Thank you, April. Just a real brief background on me. I really started my valuation career in the capital markets and somewhat, if anybody in the audience remembers that wonderful movie, Forrest Gump, sometimes I feel like the Forrest Gump of the financial industry, having the front seat at the currency crisis of 1997-98, the internet bubble, and not the least of which also sat on the desk during the time of the liquidity crisis in 2008, 2009, and managed about $5 billion of asset-backed securities. So I don't know if those are a bunch of near misses or if that is just a bunch of great learning experiences, but here I sit today in the business valuation space. And what I found is that all of those experiences are great at coming in and taking a look at the various types of valuations that we do today. So as the slide here shows, the corporate sales and advisory group can really handle a variety of different kinds of and valuations for various purposes. Sometimes I nickname these the 5 fingers of valuation, and the typical, hey, what's my company worth, all the way to we need to have somebody up on the stand in federal court testifying on the valuation, and anything in between. So one of the things I do tell people is that, we can do real estate valuations, but there is a bright line between real estate valuations and appraisals. We don't do real estate appraisals. So that is the one thing that I leave to my colleagues and brethren over there that have that wonderful credential of MAI and do a great job of real estate appraisals or things of nature that might be oil and gas. And being from Texas, a lot of people ask, well, you must do a lot of oil and gas. You'd be surprised. There's a lot of other things that are needing valued in the state of Texas other than oil and gas. But today we'll go a little bit more into the valuation gap analysis process that we've been doing for clients and really showing how important that is today, how important it's been in the past, and I think in the future is going to become even more of an impediment for companies to understand and really embrace this. So April, yeah, there you go.
Thank you, Jeffrey. So our goals today is we want to illustrate the path to aspirational value, also assist you in the process of improving operations, increasing cash flow from operations, or preparing for that transaction, of a portfolio company. And then also identify the value of having corporate sales and advisory as your advocate in this process, the tool in your tool belt, along that way.
Right. Yeah. And as everybody, I think, in the room and online probably understands that growth is expensive. And with the advent of higher interest rates in the most recent history here, growth has become even more expensive. And the companies actually, as this quote says, that the companies that I work with who are able to generate their own cash flow and then reinvest that cash flow as a portfolio manager would, if you can kind of think of it from that standpoint, are really, I think, going to be the companies that grow at a faster pace, because the question is frequently, where are we going to get the growth capital from? And if you can get your own free cash flow to help you be that growth capital, then you satisfy a big need. And that's one of the things that we try to work with our clients today, is really identifying the way that they can be their own cash generating machine that then can be, again, kind of reinvest, if you will, right along inside other investors who might be coming into the company or coming into the business. And that's important. April, yeah, there we go. So as I intimated earlier, growth is expensive because, capital for growth is expensive. And, if companies could find a more reasonable approach or a more reasonable cost to their funds, you now have an affordable way to fund the growth. And I tell people this story as we were going through and helping clients over the last 2 years who are in very early stages of raising capital, or very, very early stage companies. This incredible increase in their cost of funds has really forced a number of them to completely flip the capital that they thought they were going to be bringing into the company, because this growth, this growth capital is become so expensive, and investors have become so weary or leery, whichever you want to look at, as far as the return on investment that they're going to be getting and the timing of that return investment. So we have a lot of experience with, moving through these cycles, watching these cycles, and also helping companies get through this cycle of really, trying to help them find their own cash flow inside their company. And as April will talk about in a moment, the trust structure that again, Nexxess has put together, that we look at and utilize for clients on occasion, is really a great way to provide that after-tax cash flow that could then be used to grow the company. And it can be that less expensive form of growth capital. Back to you, April.
Thanks, Jeffrey. All right, so just a little snapshot that we're going to just cover here briefly, just showing how a company, when they're getting positioned during this time, when they may be looking to sell or to Jeffrey's point, freeing up that cash. Where are you going to get free cash from? It's holding on to more pre-tax dollars. So through proper trust structure, we can help a business owner defer active income while they're operating the business, but then also give them asset protection on their IP and other assets of the business, and position them so when they go to sell to that buyer or that acquirer, that money, all those pre-tax dollars, 70 to 90% of the capital gains tax can be deferred. And then they can then deploy that deferred capital for their next acquisition or business venture. So again, freeing up that capital for today, but then going forward, how can they position themselves in a way where they're holding on to more cash to deploy? So all this sounds great, but how do we actually achieve aspirational value, right? Talking about those multiples. So there's 3 dimensions of business growth. You have predictable profits and cash flow, right? Makes the company easier to run, foundation for growth, increases value. And this is where our current value is. With the aspirational, how do we get to the aspirational, revenues? You have predictable growth, which is the number one goal of a CEO, right? Now you have potential value, but then going up even further to predictable equity value, ultimate measure of success, right? How can you replicate? How can you duplicate and have that momentum going? And that's the aspirational value that we're going to touch on. Now, Jeffrey's going to go into a little bit more detail on this.
Yeah, and this is pretty simple math. And when we are talking to clients, the number of times, and literally today, I've had at least 2 conversations with clients who are talking about the fact that they're bemoaning what their offers are at when you look at them on an EBITDA multiple basis. And the question becomes, how do we get our EBITDA multiple higher? Well, I sometimes tell clients we might be looking at the wrong side of the equation, and especially today. Back in my portfolio management and equity analysis days, we had these wonderful regression analyses that showed when interest rates are going up, price to earnings ratios are going down. And so you can just morph that back into an EBITDA ratio today, and they really do kind of follow a similar trend. And so what we sit down with clients today and go, listen, where can we improve upon your EBITDA? Let's look at a lift on the actual absolute EBITDA dollar amount that is being generated in the company. And at that point in time, if we do cross certain thresholds, now potential buyers are more interested in the fact that you have an EBITDA level. And again, this threshold is somewhat arbitrary. I know some people have done some studies on it. It used to be $8 million of EBITDA. You could see an expansion in the EBITDA multiple at $8 million. Talking to some of my private equity fund friends and other folks in the capital markets, and they're saying, yeah, that number is moving up or has moved up significantly. And of course, it depends on the industry. No doubt about that. But what we're really telling our clients is let's focus in. Let's focus in and find that cash flow that is locked up in the business, that perhaps is being held up by some things that are strangulating or at least bottlenecking you. What are those? And so those are, again, that's kind of our next step, is to get those folks from a standpoint of thinking about, well, I got to wait for this EBITDA multiple to expand in the marketplace, to, well, what do you do about your EBITDA today to actually maybe increase that to get you to that aspirational value?
Wonderful. So how do we reach aspirational revenues? Well, first, identify bottlenecks to growth. Right? Once those are identified, neutralize them. Operate the business with a rhythm, a cadence, designed to create and maintain momentum. That momentum will keep it going. Attaining and maintaining best practices in key areas. So that's a big component, right, to having that rhythm.
Yeah, thank you, April. And then, when you really get down to that aspirational value, what are the things that are holding back those EBITDA multiples? And on the flip side, if there's anybody in the audience that's looking at companies as a potential acquisition, this is also a checklist that you may be thinking about. And I think it's going to become even more important as we go forward, because money, as our friendly Fed governor told us last Monday, it might be higher for longer. No surprise to me and most of my colleagues. But anyhow, I digress. But these company-specific risks really are going to continue to and drag down those EBITDA multiples. And what are those? Well, those, they are varied across all industries. And a lot of times it's very specific to the fact that you're a geography, or specific to an industry, or, sometimes you get those customer concentrations. And a couple of the other things that we see on a regular basis is you look at these companies and they have operating processes that are working but they're just not well documented. And if some key people were to walk out, back to that company specific risk, it really goes away, that you lose that legacy information. And all too often when I talk with business owners, we get this idea that, they are just so revenue focused and growing those revenues. And they sometimes will forget that linkage between that revenue and that value creation. And, I tell people this, and, physician heal thyself, but, manage the growth so that it doesn't create the chaos, because that chaos that's introduced to the system, well, that's risk. And that risk inside of a business is, again, going back to point number one, that company specific risk that can then continue to drag on that value. So it's almost as if you can turn the page, take the mirror on this page and look at it and say, oh, okay, let's do everything, or maybe the negative isn't point number two. Maybe you look at that on the positive, and you really do want to look at it again, the companies that are doing a very good job at operational processes, also looking at and understanding that, revenue doesn't always equal increase in value. And we can tell you countless stories where we sit in there and have a division of the company that's producing a significant amount of the revenue, but really destroying capital all along the way. And through the process that we go through with them, we identify really what that cost of capital is for them on that side of the business, and then really look at an ROI, and then determine whether the efforts put into that side of the business are really providing the types of returns that they're looking for.
Jeff, I got a couple of questions for you. So if we look at, you have like a valuation slide, interest rates have gone up, cost of capital has gone up in tandem then. So how do you account for valuations? I mean, they can't go up if interest rates are going up. Is that right?
Well, I wouldn't say always, it depends, right? And here's the thing. If you're sitting in a situation where you have this additional production of cash flow because the growth you've invested in is now overcoming the increased risk, or I should say the increased cost of capital, and you're doing that in an area, you do have certain parts of the industry, certain parts of the overall economy where that is being awarded and rewarded significantly. So I would say that in general, valuations are going to hold or maybe slide back a little bit here. I would say definitely, if somebody were to put me to the test on the capital markets, publicly traded markets, I can't tell you how much I think we have an overvalued situation going on, and we're just waiting for the market to kind of catch up.
I mean, so the basis of what I'm saying is that if the public equities are lose value, right, then their ability to purchase private companies declines.
And here's the great part about it is that in my experience, it hasn't been the public to private transactions. It's been the PE to private, to the roll up, to the strategies of taking. We've got one right now that we're working with. It looks like about 11 companies are talking about coming together, and think about the synergies that you can squeeze there and the costs that you can get out of 11 companies that are doing their own, bookkeeping and accounting. And now those costs go away. So you kind of see where it's definitely, I think the next phase, let's call it this. I think it's in a continuation of the phase, is that you have a situation where there's, again, continues to be private to private, fund to single companies, roll-ups, and it's not it may still be, but I don't anticipate a lot of public company transactions that are funded with significant amount of leverage for sure. And the equities are, equity is capital, is the most expensive capital out there. So I really think it's still in the private space. I haven't seen anything from the studies that we usually look to see, how much dry powder private equity has out there. It used to be $1 trillion. I mean, we were throwing.
Yeah,
that
I think, yeah, the dry powder argument is a little bit weak right now because dry powder doesn't really discuss how much capital on call has sent notes to their general partners saying, don't call me, right? I mean, there's a lot of that. That's what happened in 2009. So,
Yeah, exactly.
so, that's a big deal. So then you have another chart, which is on migration to a trust structure. And so when you put your company into a trust structure and then it becomes acquired, is there like a detrusting process you have to go through for the acquirer? Or maybe you can explain it because I'm not clear on it.
Yeah. So what I would tell people when you essentially.
Right there, yes, that's a slide.
Yeah. Yeah. So a destructure, a detrusting structure, that probably is a good summarization of it. But just think about it this way. It's as if you're doing a purchase agreement and there are two separate parties on the front page. You're going to be transacting with the beneficial trust. You're going to be transacting with the operating company itself. So
Two sellers.
yeah. So as the sellers, right? So typically the beneficial trust is going to hold the IP, and then that operating company may be holding other assets that are going to be valuable to the buyer. So you just have
Does the beneficial trust retain that IP or what's the word I'm looking for to
it holds
trade
it.
secrets?
Yeah. So intellectual property, or intangible assets, they could be a big, broad stroke there. So one of the things that we are really looking at and working with clients a lot on is personal goodwill and getting that out of the personal estate into the beneficial trust where it's held there. Intellectual property in a form of patents that are maybe held individually, into the beneficial trust that way. And every company is a little bit different. So we have to go through and look at the structure of the company and say, okay, what kind of intangible assets do we think reside not only inside of as a result of this company being formed, but also what do we think are really residing in the personal estate of the founder?
So we have this baby boomer generation that's all retiring. They own lots of FedEx Kinkos and dry cleaners and stuff like that. And so I think there's opportunities for lots of roll-ups, as you said earlier. But, we had a panel, probably it was 8 years ago in San Francisco, talking about, what kind of companies that are private can be acquired. And the minimum was $1.5 million of EBITDA to be acquired, just in general. So what's the size of the marketplace for those types of companies right now? $1.5 million of EBITDA. I mean, outside of the medical practices that are being rolled up like crazy right now.
Right.
But how many companies are there like that?
Oh, that's a great question. I have not seen anything that gives me an indication of how large that market is. But I will tell you that, I think one of the questions you were getting to is like, hey, at what point in time do you become a saleable company? And I think it depends on the buyer, right? I mean, if you're sitting there looking at an EBITDA multiple, if you're looking at about an EBITDA that's in that 8 million to 10 million, I mean, that is definitely a conversation that's probably going to be had with a private equity group, right? On the other hand, people that I'm talking to that have 2 million of EBITDA, 5 million EBITDA, there are plenty of people out there looking for those companies. Now, there was just a story out probably about 2 weeks ago now about 60%, like 60% of the companies that are for sale are just not going to sell. And there's all kinds of reasons for that, some of which we'll talk about here in a slide, but yeah, right there. And quite frankly, they'll just shudder. And so the question becomes, is there going to be this, and I've even seen some sociologists talk about this is the perfect move-in, if you will, for the next generation of folks who don't really want to work for anybody, that are coming out of college, and they're like, okay, great, I got some capital. I can get some capital. I can get into this business. Now, I'll hold my judgment on how successful that might be, because it might be immensely successful. We may have a whole new cottage industry in this country that emerges because of this. And this transfer actually happens in a much more efficient manner than I could have ever imagined. I hope.
Yeah, I mean, I guess that situation is like seller financing, earnouts, things like that you're talking about. I mean, Jack
Yeah.
Isaacs, who's in the audience, is more of an expert on this kind of stuff than I am, but that's such an interesting space, the seller self-financed business. I mean,
But one of the questions I had, if you can go back again to the trust chart. You're basically, a big part of the benefit here is deploying the deferred capital to reinvest. How long a period of time do you have before you need to reinvest that money? And what happens if you can't find a business? Because right now, lots of people can't find businesses to put money.
Yeah, you actually don't have the time stressors like you do in other structures. So you can actually sit on the deferred capital
For how long?
for as long as you would like. It can stay in that beneficial trust. It's in the trust that's using the tax code to defer. So it's the trust that's holding it, not the owner. So it's the structure you choose dictates the tax code you use.
and by the way, this is not a new structure. I mean, so we did something with Withers Worldwide after the crash of 2008, and they were telling everybody, listen, put all of your real estate assets and real estate operating businesses into trust, because the valuation is so low that when you have the people inheriting it, they don't have to pay any taxes on the appreciation of a real estate asset that may go 5x in 10 years, which a lot of them did, right? So I can see the value of that structure. I'm just wondering how an acquirer unwinds from it. That's the big question.
Right. To
Yeah,
that
it's
point, sorry. Yeah.
Yeah, I was gonna say, sorry, I was hoping that but essentially, it's just gonna be, when you think about the funds flow at the closing table, right? The funds flow is not going to go to, it's not gonna, 100% of the funds flow is not gonna go back to the operating company. A portion of that, so essentially the purchase agreement is gonna say, we're paying X for these assets, these intangible assets that are held by this beneficial trust. And on the wire instructions, it's wiring it to the actual trust. And then another line item is going to say, and the rest of the assets or whatever you list is going to go to the operating company. So it's really, it's very simple to unwind this. It's just really like having you've probably seen these structures before where the IP is held in a separate entity. And so a transaction occurs and you're buying the IP. Well, you have to pay that entity to acquire that IP in the overall transaction. And it's really no different in this case.
It's a fascinating topic. Yeah, absolutely.
Code that you mentioned that allows the trust to defer.
One of the codes is 643. 643 on the complex side of the tax code allows for deferral. So capital stock dividends or extraordinary dividends and capital stock dividends are excluded from being considered income as long as it's allocated to corpus, which is talking about the trust structure. It's coming back into, so like the wiring instructions, for example, the wiring instructions are going to be to that trust bank account. It's not going to be to the individual, right? So the individual is not taking possession. So there's only taxes due when there's possession, right? So there's no possession of that income.
Who controls the trust? Does the individual control the trust, or does he have a
In this
board,
case,
an
the client,
advisory
the
board?
owner operator would be the trustee, but they
Okay.
would not.
So
be
there's
the
only one
grantor.
trustee.
Yeah.
Who's the grant?
It would be somebody that's separate, far removed. So it could be a non-biased third party.
Wouldn't they have to pay capital gain, like does the grantor get the tax or get the capital gain?
No, they wouldn't. Yeah, so it's a non-self-settling, non-grantor. Mhm.
So then beneficiaries would have to get the tax bill.
Right, so when there's a distribution, so it's a tax control play. So this is about asset protection, asset control, but tax control. So not saying that you're never going to pay the tax, but you can defer it and you can control when you want to pay. So it just gives you an option.
Pay tax when the gain is.
No, if it's not, there's no distribution, there's no tax due. There's only taxes due when there's a distribution. So we teach our beneficiaries to sit within the trust. When parents pass away, the successor trustee then steps inside that role. So now they're sitting within the trust structure to deploy those assets.
I think the real roll of the dice is the appreciation of the business, right?
And I definitely, I can
In
send,
high interest rate environment. That's the,
I can give
I
you
mean-
some legal stuff on it, which I know you're.
Yeah. Do we have any
Side.
closing comments? I'd rather move to Alan Snyder in a minute, so.
Yes, if we could, yeah, so we have, we kind of got a little bit, that's all right.
No, but I think we got into the questions, the meaty questions that we wanted to
Yeah, that's
answer.
super important.
Yeah.
Yeah, so, we'll have this slide deck available for anybody, but kind of exit planning, we kind of went through this already, why people wouldn't exit. You know, Jeffrey, you could just keep it kind of, on
Yeah,
this
yeah.
side.
So this was a game I was hoping to play with everybody, and we were talking about multiples. So I always love this.
Kind of close with this then. I
Take
think,
a look at the calendar, at the bottom, the dates, and I'm like, okay, here, the buy, sell, hold, right? So you're sitting there in 2019 with full 2020 knowledge. I'm sorry, of 2020 vision of the history of multiples, and you're sitting here going, okay, at 12x, would I be selling? And the number of times I have people look at me like, oh yeah, that's I know COVID's on the way, so yeah, if I knew what I knew now, I'd sell then. Go ahead, April, hit that. Well, okay, we're sitting here in the middle of COVID now. I mean, and of course, 3/31, the world stops literally in 2020, and ironically, in July of 2020, we have this incredible expansion of multiples, and then it expands again in 2021. But if you don't play the game right, all of a sudden you miss that opportunity. So we tell people the EBITDA multiple game, or the multiple or whatever you're trying to value your business on, that's just it. Like you said, it becomes a risky situation when you're sitting there going to try and time the market and sell and get a transaction closed while the multiples are where you still want them to be. So let's turn around and
I just want to make a comment on that slide. I think it's actually a price to volume question, because I don't know what the volume is of that historic multiples. But anyway, keep on going.
Yeah, these by the way,
I'm sorry, Art Bilger?
those are SaaS models. That's a SaaS. Those are publicly traded SaaS model multiples.
Right. I'm just saying, what was the volume of companies that sold? Art Bilger has a question?
Yeah, but how much of that spike up is due to the reduction in EBITDA during that period of time?
Interesting. Yeah, there you go.
That's very much.
Yeah, absolutely. Right. Yeah. So revenues may not have changed at all. Just
Price stayed the same.
Or,
Yes.
price could have stayed the same, but EBITDA dropped.
yeah. I mean, because I had deals coming to me where guys had skipped the 2009, like getting out in 2009, 2010, and then they got crushed by COVID. It's like, I will finance the whole purchase, et cetera, and do an earn out, and they were like paying people to buy their companies from them. So
Yeah.
anyway, yeah, keep on going.
I'll just kind of close with this slide then, Marty. So it's the time factor, right? Time to market. The strength of the buyer market is an external value driver that can be timed, but not controlled. I think it's more of the timing. So time scale to reach strategic, objective. From a cold start, there's a big difference between deciding to sell. Within that 1 year, we have very little to maximize that value. But if we have time, if you have time on your side, that 3 to 5 years, that longevity, we have a good chance for that exponential growth, that aspirational value. So with that trust structure, that's kind of a separate type of thing, but just with the advisory side of things, how we can come alongside, other advisors that we're working with, where we can really, help you through that and get that multiple, right, that you're looking to achieve. So we'll kind of end there, and then we can definitely, share that with everybody else.
And you're going to make this deck available to the
Yes.
audience? Yeah, this is good stuff.
So thank you
Absolutely.
so much.
All right, thank you.